The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday, and we're going to be talking about money. So what's going on with this market? It's up and it's down. Have we seen the bottom yet? Are we going to see a bottom soon? I hope by the end of this program, you'll have that answer, and you'll know when the bottom happened. Edward Renshaw of the University of New York, out of Albany, looked at all the corrections, all the bear markets, everything in terms of recessions, depressions, what happened with the stock market during all those times. He looked going all the way back from 1872 to 1990, because the study I picked up was from the early 90s. But I think it gives great insight because there were a lot of similarities. There were 42 times between 1872 and 1990 when the stock market went down somewhere between 5 and 40%. All the time since the Civil War. Think about it. That's a fairly long time. 42 times. 29 of those happened during recessions or depressions. So 42 times you had the market going down. You had either a recession or depression that happened coincidentally with that. But 13 of those times happened, you had a market setback of between 5 and not 40% during good times, but almost 40%. 13 of those times happened when you had very good economic times. One recently, think about 1987, October 19th, 1987, the market plunged down over 30%. Over 30%. And it happened in one day. There was all sorts of talk about a recession. There was not very much talk about a depression at the time, but people were talking about the years it would take to recover. You know, it was down 33% actually, and the recovery happened or a third of the recovery happened within 3 months. Typically, during those 42 times, the recovery has happened over a period of time, but 1/3 of the recovery is from the bottom to 3 months later, you recover 1/3 of what was lost. So if you lost 30%, you recover 10% in the first 3 months. If you lost 15%, you recover 5% in 3 months. And it's been fairly consistent. Even if you look at what happened in the plunge from 2007, 2008, 2009, we reached a bottom in March of 2009. We recovered a third of that plunge. We recovered a third of that by summertime of 2009. Now the rest of that took some time to unroll and happen and roll back to what had happened before and to set a new high. But the first 90 days, you saw a recovery of 1/3. And not only that, if you look at what happened in the year following, the 12 months following that bottom, in 1987, the market was down, actually I said 33%, it was down 37%. It took a total recovery of about 9.9 months, and the market in 12 months was up 23%, 23.2%, and 25.3% in the second year after that. If you look at 1990, the market was down 13%, but following that bottom, in the next 12 months, the market was up 29%. The second year, it was up only 5.6%. There's no guarantee of what's going to happen, but usually it takes 90 days for the market to recover a third. The sad thing is you don't know where the bottom is until 90 days afterwards. You have to wait. So did we reach a bottom a couple weeks ago? I don't know. We have to wait another 2.5 months to know if we really reached the bottom. You know, if I go back to 2008 and think about what was going on, we reached a couple bottoms, and in November of 2008, the market hit a new bottom. And I said on the radio show in 2008, I think we've hit a bottom. I was wrong. The market started up, and it started that trend line. It started to follow all the way up. It started that same correction. It looked like it was going to be back within 90 days. It was going to be back 1/3 of the loss. It was mid-November through December. It went up. We had 6 weeks. 2 weeks of January, it looked like it was going up. So we've got a total of 60 days, and then it started to roll over, and we hit a new bottom in March. That was almost a terrifying experience as I lived through that. I'm sure it was more terrifying for you. Maybe it was more terrifying for you, but it came out of it. And then from March of 2009, the market moved up, and after 90 days, you could really say we've reached a bottom. So it takes that amount of time. But in this time, I don't believe it's a recessionary time. I said before, Renshaw looked at the times in which the market went down 5 to 40%, happened 42 times. Only 29 of those were indications of recessions. Paul Samuelson wrote an economics textbook, the one that was most used in the country for a period of time. And he started, I think it was chapter 3, by saying, the stock market has correctly predicted 9 of the last 5 recessions. You know, what he was saying is essentially what Renshaw was saying. That even when the stock market goes down, you can't be sure that a bad time is going to follow, a bad economic time. In Renshaw's case, 29 times out of the 42, the market did go down into recession or depression. But 13 times, you just had a setback and a correction that happened during good times. And I believe that's where we are now. But if you listen to the debates that are going on, you have 2 different approaches. You have the Democrats that want to justify what's going on, and you have the Republicans who want to be elected into their congressional offices, into the presidency, and they tell you how bad things are. You know, I think it's a difficult time. Richard Bernstein wrote an article saying it's difficult for investors, but not necessarily for investing. It's one of those times in which I believe it can be easy to hear what people are saying instead of looking at the facts. It's an election year, and the debates are going on, and there's an agenda for the Republican candidates to talk about how bad things are. But you know what? It's not that bad. The economy is cooking along and doing well. You know, their message seems to be, just be scared, things are bad, but trust me, things will get better. But you know, the economy and business aren't so bad. If you look at Seattle, we have one of the hottest markets in the country. You know, but we're not atypical of what's going on. You know, we're talking from the beginning of the year, all this talk about oil. Oil price goes down, the stock market goes down. Oil rallies a little bit, the stock market goes up. Traditionally, when oil prices go down, it's a positive for an economy. Oil prices go down, it means the consumers are paying less for gasoline, and they're spending that money elsewhere. And if you look at the statistics, in 2014, the average consumer spent $2,500 on gasoline. $2,500. It was 4.2% of their income. JP Morgan Chase did a study of their customers, one of the largest banks in the country. They have a lot of access. It was not a survey. They can actually look at what their customers are spending money on. And they found that in 2015, the amount they spent on gasoline had dropped from $2,500 the year before to $650. It had dropped from 4.2% of their income to 1.1% of their income. There was over 3% of their income, after-tax income, left to spend on other things or do other things. And looking at the accounts and what they were doing, for every dollar that they saved, or every dollar that they didn't spend on gasoline, 11 pennies went into savings. But 89 cents went into other purchases. For every work in the country, they reduced their gasoline expenditures from $2,500 to $650, and they spent $1,646 on other things, whether it was a big SUV or whether it was a washing machine. And very often what they were buying were big domestic things. So that will add about 1.5% to GDP. We've talked about slow GDP. It'll add about 1.5%. On the negative side, you have some capital investment that's not going into the oil and the mining industries, and you have the strong dollar. Both of those will be taking about 0.9% off the GDP, but the net effect is a positive increase, and a very positive increase for what's going on here in the U.S. We have a very positive economy going on, and it's showing up in the numbers all the way across. We're going to be coming up to a break, so don't go away. I've got a great guest who's got a great story to tell. That's coming up soon. And I want to take these things and talk about them as we go forward, because I want to apply them in the later segment. Don't go away. I'll be right back after the commercial.
More about money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So Daniel Patrick Moynihan said, everyone is entitled to their own opinion, but no one is entitled to a different set of facts. You know, the facts are what the facts are. And the reality is, as I started to say, as I was saying in the first part of the program, is the economy is doing well. The drop in price in oil is having a positive impact on the economy. And we're seeing that all the way through the economy. We're seeing in the oil patch real problems. We're seeing problems in mining. But when you add everything together, we're seeing workers, and we're seeing a very low unemployment of 4.9%. And yes, it's a real number. And we're seeing wages increasing. They were 2.12% up last year. They're continuing to increase this year. We're going to see wage growth. We're seeing low inflation. We're seeing oil and gas prices low. We're seeing an excess of commodities, which are driving down commodity prices, making things cheaper for U.S. citizens to buy. We're seeing, with the excess in steel production and aluminum production and commodity production, we're seeing all this impact through the economy, which is making things cheaper for U.S. people to buy. We're living in what Richard Bernstein called the Walmart world. Walmart world, because Walmart comes into a new market, they cut prices to gain market share, and that's what's happening with the rest of the world. That's what we're seeing right now. We're seeing the bursting of the credit bubble, which has impacted emerging markets. It's impacting junk bonds. It's impacting commodities and oil and gold and REITs and private equity and hedge funds. All of those things are suffering through because they were so dependent on credit. That is now coming to a point where it's going to be a couple years for that to work through, and it's going to be a very good time. We're seeing small businesses increase their hiring practices. We're seeing the dollar strengthen, which is giving us partly buying power for things that are being imported. Everyone's entitled to their own opinion, but no one's entitled to their own set of facts. So from this first segment, there's two takeaways that I hope you'll take away from this. Number one is the economy is strong, unemployment is low, the budget deficit, we didn't talk about that, but the budget deficit is historically at low levels. Prices and low prices of oil are stimulating the economy. Small businesses are hiring, wages are going up. All positives for the economy. That's the first thing. The second thing to take away is that it takes 90 days to know if we reach the bottom. I mean, the market was up 2.5% by the Standard & Poor's this week. Did we reach a bottom last week, and are we on our way up? It's going to take us 3 months to know for sure. We could roll over and go to a new low, but maybe we're on our way up. We'll know in 3 months if it was really the low. But I want you to hang on to those two concepts. We're going to come back to it. But right now I want to change, and I want to introduce my guest because he's got a fascinating story to tell. It's Justin Farmer, who is the president of Digital WarRoom. Digital WarRoom. What a company name. Anyway, welcome to the program, Justin.
Thanks, Mike. Happy to be here.
So why don't we start with your background?
Awesome. Yeah, so I'm locally grown. I've been here for my entire career. I was a business school, Foster School of Business graduate, University of Washington. I attended the Seattle University School of Law and been in business and law ever since.
So you started in a different practice of law than you are now.
Yeah, I actually started off as an assistant attorney general in Olympia, advising basically the business side of my client, which is DSHS, contracts, lands and buildings, that sort of thing, and then transitioned into private practice, so trying my hand in more complex litigation and bigger matters, business matters, that sort of thing. But realized pretty quickly after about 4.5, 5 years of practice that my business background was calling. So I made a shift to non-traditional practice, is what we would call it as an attorney. And I went inside an e-discovery and legal staffing company. And that's where I was prior to joining Digital WarRoom.
So let's talk about Digital WarRoom. So tell us about what Digital WarRoom does.
So Digital WarRoom is a pretty robust and kind of fascinating software. It's an end-to-end, what is called e-discovery software. And in order to kind of get to where we are now, I have to give you the history of where we've been. So
please do.
Thank you. So the history is unique, and in this industry it's important because there's so many people trying to get into this industry. It's a booming business model and a booming industry, so more and more people are trying to move into the space. And our company's been around since the early 2000s. We actually were founded, our founding members were part of a small firm, I say that tongue-in-cheek, Preston, Gates & Ellis, now K&L Gates, and they were part of the consulting arm of that firm. And they were tasked with what some would probably think is an impossible task of representing Microsoft in the antitrust case in the early 2000s. So our founders were given this task, hey, how are you going to figure out what data our client has and help them get through their litigation? So the end result of that task was the creation of a software, which is called Attenix at the time. And Attenix was groundbreaking. It was one of the first e-discovery softwares ever. And our CTO, Dan Gallivan, is probably one of the smartest men I've ever met. He is the record patent holder of several e-discovery patents to this day. And that's how we got our start. So they formed this spin-off software company, and after what happens in this industry, that software company was gobbled up, and then that was gobbled up. They decided to move on and start their own company, which was a full-service, end-to-end e-discovery consulting company. And at that time, they decided, we're going to go out and manage these large cases for our clients, but we're going to build a software in-house to get it done. We're not going to use any of the other softwares out there. And so that's where Digital WarRoom got its start. Digital WarRoom was actually a software that we used internally for about 12 years before we ever turned it around and sold it on the market. So if you know software, whenever you buy something 1.0, 2.0, 3.0, iPhone 4, 5, 6, you see where I'm going with this. When our software hit the market, it was actually in the high 7 dots. We're at 8.8 now. So before our clients ever saw the software, we had used it for 12 years and developed a pretty robust software.
So tell us what the software actually does.
That's a great question. If you're listening, your attorney, you'll understand. The best way to put it is everything is electronic now. Everything, your email, your phone, the documents you create on a day-to-day basis to run your business, everything is electronic. So how does one, if they're responding to something that someone says, you stole my widget, no, I didn't, how do you get to the bottom of whose widget it really was? So you have to figure out and go through all this data. And our software allows you to, in a very fast, efficient, and kind of groundbreaking way, move from collecting the data wherever it is to reviewing it and figuring out like the nuts and bolts of your case, to then producing it to your team to prepare for trial, prepare for depositions or expert testimony, but also looking for the smoking gun in the opposing side's case. End to end, our software does all of that.
So in the old days, I can imagine it's like you see on TV where they take boxes and boxes and boxes of paper. And in the old days, I assume what they had is you had a lot of paralegals and junior attorneys who would go through page by page by page of all those documents.
Exactly.
And
well, and it's funny that you mentioned that. The term war room, if you go to any firm and you talk about a war room, show me your war room. They'll take you to a room where some associate is locked up, chained to his desk, and he's going through boxes and boxes of data. That's still alive today. That was a war room. Digital WarRoom is taking that environment, that associate chained to their desk, putting it into a readily reviewable form, digital form, and allowing you to go through your case much faster. We also have some, all of our software is proprietary. We also have something that we developed in-house that is pretty groundbreaking. It's technology-assisted review. We call it TAR 2.0. And it actually speeds up the review even faster. So if you have 5 million documents, you can use our TAR 2.0 software to actually get to the documents that you need much faster.
So your software actually sorts not by word, but it has to almost think like a human being.
That's right. Yeah, so think of it like this. The best way the analogy I could think of is we all shop online. We shop on, let's say, Amazon, for example. And let's say you buy an iPhone case. Oftentimes what you'll see at the bottom, it says, hey, you may also want to buy these headphones and maybe this charger and this cord. What it's doing is trying to predict your future behavior. What do you, based on your shopping behavior, what do you need next? That's what our software does. Based on an attorney's, a human's mark or their search, our software is saying, hey, I think you want to look at this next. This is going to follow your case. And it's groundbreaking. It's really, I think it's neat as e-discovery software can be.
And I imagine it's been truly economical for a lot of firms to use rather than using tons of paralegals and junior attorneys.
Sure. Well, and actually, this industry is lagging behind as far as where cost is really going. Kind of talking about this segment, why should it cost X? Our industry is pretty pricey. Most of our competitors are exorbitantly pricey, and we're not. We are. Best way to put it is we're price disruptive. We are offering something that no one can touch at a price that no one dare go to. And that's because we own our software. That's because we own everything that we're talking about today. And we're really trying to help our clients save money.
We're going to come back to this right after the commercial break, and we are coming to a commercial break. Want to hear the rest of the story? So stay with us. And we want to come back to the two takeaways from the first part of the program, too. So stay with us. We'll be right back after the break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Justin Farmer of Digital WarRoom. We've been talking about what Digital WarRoom is. You also mentioned during the first segment, or during the previous segment, that you were seeing a lot of new competitors come in. It was a very hot space. So what sort of firms are competing?
So you have two types of firms. You have one is the software. And in our space, I think there are less softwares than there are of the second type, which is service delivery. So there are the service delivery companies or consulting companies are going to be using someone else's software to get the job done. So our software being, that I talked earlier about collecting the data, processing it, help someone review it, and then getting it out for your case. The software might fit one of those 3 or 4 bubbles, and then the service company fills the rest. Ours is put a square, put a package around that entire flow, and that's what we do. Our competitors are also, even as they're coming into the space, they're trying to do something that is different, and they're saying they're doing something different, but they're really just the status quo repackaged. The status quo being charging per gigabyte. So think about e-discovery. Why is it necessary? Everything's electronic. 10 years ago, a gigabyte was a lot of data. Now your iPhone has 64 gigabytes on it by itself. My first laptop in college, I don't even think had a gigabyte, and it was the size of a desk.
Yeah.
Now you have an iPhone that can have, I don't know how big they go anymore, but so that gives you an idea of how much data is really out there. And so the status quo is charging to do those things by the gigabyte. So as more and more and more data comes in, they're making more and more and more money because it's just so much more data, and they're charging per gigabyte. In some cases, $95 per gigabyte is, and if you have a terabyte of data, you can do the math, and they charge per month for that certain service. So $95 times 1,000 gigabytes equals X amount per month, every single year. Our service has gotten rid of per gigabyte pricing. We do not charge per gigabyte. We offer a subscription model, so you come in, it's all you can eat, and it's just software as a service. You come in, you subscribe, you get to use our software. It's what everyone else in other industries is offering. The phone industry being slightly different, but the idea is we want our clients to be able to budget. We want them to be able to accurately understand what a case is going to cost them, because they need to turn around and tell their corporate client in many cases what it's going to cost to actually be represented. And the old guard is kind of that bait and switch. Well, it's going to be X, but they know darn well that as soon as they get the case, it's going to be 2 or 3 times X. We're not into that business. We are transparent, highly ethical. Come see us, and we will show you exactly what it's going to cost. And if you wanted to pin us down on a per gig price, which many of our clients, because they don't understand that per gigs is not what we're offering, pricing, we have to tell them we offer hosting storage at around 50 cents per gigabyte. Most of our competitors are 5, 10, 100 times more than that, literally, like $25 a gig. We're at 50 cents. So in that way, we're very disruptive, and I think we are looking forward at where this market is going. The idea of charging someone $25 per gigabyte to store data is absurd. You can buy a flash drive for, it used to be, $100 got you 1 gig flash drive. You walk through Safeway and they have a 100 gigabyte flash drive on the aisle next to the candy for $1, $2. Yeah. And the fact that our competitors continue to charge this incredible rate to do just that, just hold data, is something that we have completely thrown out.
So as I hear what you're talking about and saying they're charging X amount per gigabyte, I'm not quite able to reconcile how that works, because if you have a case, you do all this e-discovery, you develop all this data, and it's a one-time kind of through the deal, and then you have the data and the repository and the inventory of data, but they're continuing to charge
exactly
ongoing.
So you have to process the data, and they'll charge you per gig for that. Sometimes $95 to $200 per gig. With us, it's zero. You subscribe, you can process all you want. It moves into the review platform.
Wait a minute. When you said process,
yeah,
what you're actually talking about is going through each of those documents. Is that correct?
So the processing is when someone is going out and grabbing data that might be responsive to a case, they have to. It's hard to tell what you're getting. So you get this giant grab of data. Everyone who might have anything to do with the case, grab all their data, and then you process it. What that means is you look at the data you collected, and then you look at the case. So if the case has something to do with contracts over 2014 and 2015, you may have collected data that was from 2010, 2011, etc. That's not responsive. So you process that out.
Okay.
You run a process to get only the data that's responsive to the case. Our competitors will grab all that data, they'll process all the data, and they'll charge you per gig for even the stuff you don't need. What we're saying is you process it, that's part of your subscription. Then that moves into what you just mentioned, be able to review it. I want to look at the document and actually see what it is, eyeballs on documents. Then they'll charge you $25 just to review the documents per gig. And even if you're not doing anything, it's called hosting, right? They're going to charge you hosting fees per month at a per gig price of 25 or 22, 35. It's all over the board. Everyone's trying to be competitive in the 20s now, I'm seeing. We offer a set subscription, all you can eat, but if you really need a lot more space, talking about to host, we're at 50 cents. So one of our major competitors, who I won't name now, is right around $22 per gigabyte just to host the data. We're at 50 cents. So I'm no mathematician, but that seems like a pretty good deal to me.
It is a pretty good deal. So once the case is over, then do the charges go away?
Good question. With our platform, you can do something that is also groundbreaking. You can archive the data down. You do not have to keep it up in the cloud. Many of our competitors make it difficult to get the data out, and that's how they get that annuity. They keep you in, and it's hard to get the data out. Or you have to pay them that processing fee again to process it out or produce it out, some sort of money out per gigabyte to get it out. With our software as a service, you're able to archive it down yourself, and we actually encourage you to. We will work with you as you're reaching your capacity and say, hey, you may have some inactive cases. Can we show you how to archive it down? Save yourself some money.
It all seems like it's really cost effective to use the Digital WarRoom. It's more effective all the way through cost-wise and process-wise when you look, and I'm using the word process to cover the entire thing.
Yep.
But you cover from the beginning to the end. You have the software plus the case management.
Yeah, we are what we call, we're end-to-end. Many of our competitors are saying now that they're end-to-end, but really what they've done is cannibalize someone else. They may have had a great review platform or mediocre review platform, and they go out and they buy another software and patch it on, and they say, hey, it's end-to-end. Our software was always built end-to-end, so you can go from the beginning to the end of the case and never skip a beat, never have to move the data from one platform to another. That's a nightmare. our competitors are patching things together to say they're end-to-end because they're trying to capitalize on that high per gigabyte pricing they can get on the front end and the back end, that processing, like I mentioned before. Again, because we own our own software, it's a proprietary software, we are not beholden to anybody. We're able to give a subscription to a service that's end-to-end and eliminate that per gig pricing.
So one other question. So if someone is involved in a big case, can they choose who does the digital e-discovery?
Are you asking
Can he direct his attorneys, his
Absolutely.
his legal counsel to?
Absolutely. That there's kind of two foods for thought here. The corporate client might have already talked to someone like me, and when they get sued, they retain counsel and say, hey, by the way, call Justin at Digital WarRoom. I want to use their software. That's one way. But oftentimes, the corporate client, maybe they don't get sued very often, and they don't know the industry, so they rely on their law firm to pick a vendor or to do what they need to do to get the case done. And so right now we're in this inflection point where we're really educating a lot of clients who are using the status quo, and rightfully so. I mean, that's what they know. I mean, oftentimes it's hard to move away from what you know. But as we're educating them, I had several conversations before coming on the radio today with clients who are using some of our competitive software, and their best is shock. They're shocked at what we're offering. Now, can we deliver? Absolutely. Have we showed them we can deliver? Absolutely. And when we do that, it's just opening up even more.
So what size of case, very briefly, and we're coming to a commercial break, but very briefly, what size case, how many documents does it make sense for you to be employed with?
With our software, one of our taglines is e-discovery for everyone. We want, no matter how big or how small the case, you can utilize our software efficiently.
So if someone wanted to get a hold of you, how would they do that?
You can visit us at digitalwarroom.com, or you can email me directly, justin.farmer@digitalwarroom.com.
That's great. Thank you very much.
Thank you, Mike.
A tremendous change in what's gone on over the past 10 years.
Thank you.
Thanks for being on the program. We're coming to commercial break. Don't go away. I want to come back to these two takeaways from the beginning of the program. I've got more to say about those. So don't touch the dial. Stick with us.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So from the first part of the program, I was talking about two takeaways I wanted you to come back to. We're coming back to those. One is that the economy is doing well. Unemployment, 4.9%. The budget deficit is low by historical standards. Surprise, surprise. We have low oil prices that are stimulating the economy. It's benefiting the consumer, and it's showing up all across the board. Small businesses are hiring. Wages are going up. All of those are positive for the economy. That was one takeaway. The economy is doing well, regardless of what's being said during these election times. The economy is doing well. The second thing is it takes 90 days to know if you're in a correction, or 90 days after you hit a bottom to know if you've actually hit the bottom. It takes 90 days, 3 months to know if you've really hit the bottom. Did we hit it last week? I don't know. Ask me in 3 months. I'll tell you at that time. You know, I talk sometimes because I say that history doesn't repeat, but that it rhymes. It's worth looking at history. It's worth looking at what's happened in the past. And so I look at some of these studies that have been done in the past, like the Renshaw study, but there's another couple studies that are worth looking at. One was done by Peter Lynch and John Vanderheiden of Fidelity. They looked at the time period 1981 to 1991. And they said during that period of time, if you missed just the 10 best days of trading, just 10 out of 10 years, that's an average of 1 day per year. If you missed 10 best days of trading, your return during those 10 years would drop from an average of 14% per year to 4%. Think about it. Missing just the 1 day per year on the average, just 1 day per year, you drop your return from 14% to 4%. You know, Carla Freed repeated that and put that into the Money magazine, looking at it in 2007. And she looked at it, the market had changed during that period of time. Of course, we went through the dot-com thing. But she looked at that period of time and said, when the Standard & Poor's during that period of time was up 11.8%, if you missed the best 10 days, you would have dropped your return by almost 50%. During that period of time, $10,000, if you just stuck in the market and not made any moves, if you just had market returns, $10,000 would have grown to $93,075. But if you missed the 10 best days, instead of $93,000, your return would have been $56,000. If you missed just the best 30 days, your return would have dropped from $93,000 to $28,000. And if you missed the best 50 days out of that period of time, from $10,000, you would have been at just $15,000. Now, you know, the reality is you can improve your returns if you miss the worst days. You can do the same thing. If you miss the 10 worst days, you can significantly improve your returns. If you miss the 50 worst days, you can truly improve your returns. And in fact, more so than if you stay in. But the reality is you have to know or have to guess what are the worst days. And you have to be in for the best days. And there have been any number of studies. Dalbar's done studies. Cerulli's done studies. The SEC has done studies looking at how people do. And what they find is very often tactical performance, those people that move in and out of the market, actually do better during downtimes. But they more than offset that by missing the uptimes. The best way is a buy and hold strategy to work through all of that. That's what Peter Lynch did. That's what Vanderheiden showed. That's what Carla Freeman showed in those studies, that it's better to stay in the market. Morningstar found exactly the same thing. Tactical advisors, tactical money managers underperform the market. Eugene Fama, I've mentioned any number of times, he shared the Nobel Prize in 2013. His studies show that fewer than 7% of money managers actually perform as well as the market when you count their fees and performance. I believe that number is probably on the small side. I think the period of time was contorted by going through 2008, 2009, but I believe any number of studies. Alice puts it at 10%. Burton McKeel has put it at around 10%. Fama, 7%. In any case, over 90% of the time over the long run, people that try to trade in and out of the market underperform. It's the people that stay in the market that do it. There's a Dalbar. Dalbar does a study, and they've been doing a study now for 30 years as of the end of 2015. Actually, the end of 2014, because we just finished 2015. At the end of 2015, they had 30 years worth of data, and they looked at how the average mutual fund investor did compared to the Standard & Poor's. And the numbers are pretty revealing. The average equity mutual fund who was buying stock mutual funds got a return over those 30 years of 3.69%. If you'd just been in an index fund during that time or in the market, 11.11. What that really means is if you started 30 years ago with 100,000, the average mutual fund investor would have seen that 100,000 grow to 286,000. Seems pretty good, right? Think again. Had you been in the market and stayed in the market and gotten market returns, you wouldn't have 286,000. That 100,000 would have grown to $2.1 million. It's very significant. Bonds were the same way. The average bond fund investor was getting 0.7% versus 7.67%. And we've come through a really good time with the bond. The bonds have been in a secular bull market since the end of the 80s, since the beginning of the 80s. So 100,000 for the average bond investor would have grown to 122,000 just in the bond equivalent fund. To the equivalent index fund would have grown to 850,000. You know, consider that inflation during that period of time ran at 2.8%. If you're getting just 3.69%, what you really got was less than 1% return if you were the average mutual fund investor. It makes sense to be long-term. In the 20th century, we went through the Great Depression, through numerous recessions, through 2 world wars, communism, the Cold War, 2 presidential assassinations, Chernobyl, multitudes of problems and issued. With all those negatives, the Dow went from 66 to 11,467. That was how the Dow did during the 20th century. It makes sense to hold long-term. That's the strategy that's going to produce the best returns. That's what we do at Adams Financial Concepts. That's why our returns are what we post on our website, and you can see them there. They are pretty good, even if I say so myself. Anyway, you can like us on Facebook. You can follow us on Twitter. We do tweet, and we should be tweeting at this time. Like us on Facebook. Check our website. It's got the performance numbers and the blogs. And until next Friday, have a very good week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Your business leader for Seattle is 1300 KKOL.
following program sponsored by Adams Financial Concept.